All right, everybody. Stocks by the numbers. Welcome back. It's Wednesday. It's about 1 o'clock, T-minus 1 hour until that Fed rate decision. But I wanted to talk about a couple of these T-bond ETFs that we could potentially see some movements in after this rate decision comes out. Because what I'm noticing here is, see this 10-year here? It just dipped below 4% here. It's at 3.963%. And, of course, the 20-year is up here at about 4.33%. But basically what I'm seeing is usually this 10-year, what I'm noticing is that they're selling it off and dipping it down below 4% to try to justify the rise up in stocks, right? Because we know the old rule is when yields go down, stocks go up, right? So what I'm seeing here is that they're forcing these yields down to pump up these stocks and bring us up to new highs. However, once we dip below 4%, you can see that we're kind of immediately retracing and regaining back above that 4% level. So now, with the 10-year down over 1.75% here, and we're sitting here at sub 4%, in my opinion, of course, we have to wait and see. We have to wait for confirmation, because as we say, it is much easier to react than it is to predict. But I will say that, in my opinion, I have a feeling that these yields are going to climb back up. And if this 10-year starts to climb back up, what's going to happen is, again, as yields go higher, stocks actually may continue down and go lower. So the NASDAQ and the S&P may continue down into the red over potentially even doubling from this level. So we could see a drop potentially of about 1.5% in the SPX. We can see potentially a 2+% drop in the NASDAQ. And of course, the Dow will probably go red if this happens. And we can see a drop probably of at least 100+ points there on the Dow. But more importantly, if this 10-year gets above 4%, what's going to happen is, again, as the stocks go down, it's going to potentially eat away at your account. So you're going to need something to offset those losses and try to make gains as everything else is selling off, also known as a hedge play. And in my opinion, what you're going to do is, I, again, would wait for confirmation, but this is an ETF that I would be watching here. Ticker symbol IEF. This is the iShares 7 to 10 year Treasury Bond ETF. And you can see that as yields were going up here throughout after the summer months when we had that sell-off, yields were going up, stocks were going down. So the ETF goes lower. We spoke about this with TLT also. That's the 20-year Treasury ETF. And what you're seeing here is that as yields began to sell off, this ETF began to climb in value, right? And even today, you can see that it's up almost 0.7% while the 10-year is down. So, in my opinion, one of the best hedge plays here for your quick little short-term trading account could be puts on IEF if this 10-year jumps back above 4% and reclaims that level and wants to go back higher. And again, on the 20-year, just to switch over, this is an ETF that we looked at in the past. You can see I drew out a lot of trend lines here. We were tracking it for a while. We had the flash crash, then it regained, retested that fib, and then you can see we have the small bounce today, up 1% as the 20-year is down 1.25%, right? Because they move inverse of each other. So again, in my opinion, you're looking at ticker symbols IEF, the 7 to 10-year T-bond ETF, and of course, you are looking at TLT. This is the 20-year T-bond ETF. So as these yields potentially start to climb in about the next hour, hour and a half, buying puts on TLT and IEF, in my opinion, could be a phenomenal hedge play here in the immediate short term, and you can book some profits as you're potentially watching a few of your other positions just slightly begin to sell off if the markets begin to drop down. Now, obviously, if the opposite happens of what we just expected and yields happen to drop, which again, in my opinion, I don't think is likely, but of course, anything can happen. So if yields do begin to drop, obviously you would inverse what we just said, and you could potentially buy calls on these situations. But on the flip side as well, you'd be able to get in some index calls as well. But basically what I would be looking for, in my opinion, I would be looking for IEF, TLT, and of course, more importantly, what I would do is I would keep an eye on the stocks that, in my opinion, we quote unquote kind of know are under or fair value that we could potentially even get for a more attractive price. And I'm looking at stocks like Safe Bulkers, perhaps Rolls-Royce, again, RYCEY. I would be looking at brand name blue chip companies as well. I would be looking at stocks like Philip Morris or Coca-Cola, ticker symbol KO. Wait for them to sell off and get beaten up if markets do happen to sell off. And then we swoop in, we buy brand name stocks at deep discounts. Stocks like Fubo, if it happens to go red, right now it's up about 2.33%. If a company like Fubo, in my opinion, it's a screaming buy down here at sub $3 in general. But again, you understand the big picture. If stocks really do begin to pull back and we see something like a Fubo drop from 264 down to 254, 251, again, that is when you step in and you accumulate a position. But I just wanted to do a quick video because I wanted to let you guys know that there are still plays out there if yields begin to rise and your stocks begin to go lower. Because a lot of times what happens is we just get upset, we start to see the redness, and we get emotional, and it kind of clouds our judgment. When in fact, there are multiple ways to hedge yourself against these type of movements in the market, and it's knowing all of these different symbols like this, knowing what this does when this goes up or this goes down, so that you can plan accordingly and develop a strategy for yourself, right? So I just wanted to remind you guys about these ETFs, how they move when these 10 and 20-year yields go up or down, and what you could potentially do here inside of the next 2 to 3 hours before market closes to try to make yourself some quick profits and a couple of quick scalp trades. But I'm going to end it there because that's all I have to say. So once again, Stocks by the Numbers, I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain, especially on days like today. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. I'll see you guys in the next one.